Today we're going to start a new chapter on capital budgeting. Basically, we're going to look at ways of analyzing the long-term investment. But before we jump into our new chapter for today and for next week, we're going to cover this chapter in 2 weeks. A bit of a quick announcement. First thing to mention here is that we have a new forum for you guys to share your opinion over here. There is a forum. A question is really simple. Once you click here, you see the question. In your own words, explain the difference between bond valuation and stock valuation. So valuation is basically calculating a fair price, in this case for a bond and for a stock. We talked about those topics in the previous 3 weeks. So those two topics are quite different. They're completely different, to be honest. So there is a lot to talk about. You can mention different things. When you answer the question, what is the difference between bond valuation and stock valuation? So in your own words, there isn't much wrong or correct answer. What's your opinion? What's your understanding of the differences between bond valuation and stock valuation? There are also some similarities. For example, when we talked about bonds, we've mentioned perpetuities. I'm not going to explain things again now, but perhaps that rings a bell. Perhaps that reminds you of something. Perpetuities, maybe those are kind of similar to stocks. I don't know. We don't usually expect a business to go out of business in the next 3 years. Perhaps we usually expect businesses to keep operating. For example, Coca-Cola is quite a modern company. A lot of people drink Coca-Cola. A lot of young kids drink Coca-Cola. It does sound to be quite modern, but actually, if you look at it, Coca-Cola is over 120 years old company. So maybe there are some differences, but also maybe there are some similarities between bond and stock valuations, particularly between stock valuations and the perpetuities, perhaps. So anyway, give me just several sentences, 3-4 sentences as a reply to what you think are the differences. Okay. Do it sometime this week until the next class next Friday. All right. And as I mentioned in that email I sent to everyone, this also will be counted as part of those weekly tests. But besides that, we'll have our regular test for today for this class as well. Okay, so just have a look at this question. So, capital budgeting. What are we going to talk about over the next couple of weeks? Longer term investments. So it's basically a situation where an existing company wants to open a new division, or perhaps a situation where an existing company with already several factories all over Taiwan would like to build another couple of factories, I don't know, say in Japan or in Mongolia, right? So we are talking about long-term investments. We are talking about long-term decisions, as you see. It also means that the expenditures, the investments are pretty large. So we're talking about long-term, large investments over here. Okay. So basically, let's call them projects. Throughout this couple of weeks, we'll just keep calling them projects. Whatever it is, a new business line that you're opening up, maybe a new business that you're opening up, or maybe several new factories or one new factory that the company decides to build. Okay. And some of the features of this type of long-term large investments is that they're very difficult to reverse, meaning that it's very difficult to change your mind about these sort of investments once they've already been started. Once you've already started building the factory, right? You've already acquired the space for this factory, you've already acquired all the materials to build that factory, you already have the contractors signing up the contract for you for the next 1 or 2 years to build that factory. A lot of the expenditure is already done. So if later you decide to change your mind, oh, I don't want the factory anymore, it's still going to be really, really, really costly for you, for your business. Okay. So we're talking about really relatively important investment decisions. Okay. And they're so important that they basically kind of determine the whole direction sometimes for a company, or at least for a division over the next several years. Okay. So basically we're going to talk about relatively important investment projects. And what's the topic for this chapter? What are we going to basically actually do when talking about these important investment projects? Well, we're going to learn how to analyze them and come to an answer in all of these cases. We're going to look at different ways of analysis, different methods of analysis, a lot of different examples. In all of these cases, the answer is going to be either accept or reject, accept or reject, accept or reject. Very easy. Okay. So, for example, is it a good idea to build these 2 factories in Japan? Okay, let's do the analysis. Let's get the data. For the exams, of course, you will be provided the data, right? Do the analysis according to this calculation, or do the analysis according to this and that of the other one calculation, different methods. Okay, what's the answer? The answer for the calculations is this such and such amounts, but what's the final answer? The final answer is always going to be either, okay, accept, yes, this is a good idea, let's build those 2 big factories in Japan, or reject, no, it's not a good idea, we're not going to make money. We're only going to lose money on this, so we're not going to build those two factories in Japan. So that's the main idea of this whole chapter for a couple of weeks. Basically, it's different criteria for your investments that we're going to look at. So basically, we're going to look at different methods of calculating whether an investment idea, a project, is a good idea or not a good idea. Okay. And before we actually look at the calculations of those different methods, what we want to see in those methods, what we want to see in those criteria, a criterion is one feature that you are looking at, or like a method of looking at an investment project. So criteria is the same as those methods of analyzing your investments. We'll have a look at several criteria. Some of them are better than others. Some of them are good. Some of them are not as good. Some of them are quite strange. Some of them don't even take into account all cash flows. Let's say, for example, you're going to build a couple of factories in Japan. And let's say you expect those factories to operate for the next 30 years. Maybe after 30 years, they're going to be too old and not going to be operational anymore. But say they're going to operate for 30 years. Of course, they'll probably generate cash for you for the next 30 years because they're going to operate for the 30 years period, right? But strangely enough, as you will discover, some of these investment analysis methods don't even consider all of those 30-year cash flows. Maybe they will just consider the first 5 years, the first 10 years, whatever. So there are different methods we're going to look at. Some of them are better, some of them are not as good. And for the better ones, these are the features that we want to have a look at in our analysis. Projects are likely to generate cash flow for your business. And when we analyze projects, project is basically an investment idea. Before we actually build those factories, we want to say whether it's a good idea or not. When we analyze those projects, of course, we do want to take into account all of those future cash flows. Okay. Another thing we want to take into account is the time value of money. The time value of money. Money now is more important than money in future. For example, if the business involves investing 10 million now to receive 10 million 3 years from now, it's not a good business. Because 3 million now is not equally good as 3 million 3 years from now, it's not the same amount. Because if instead you have that 3 million now invested, keep it for 3 years, invested at some interest rate, even just a 1% interest rate in the bank, 3 years later you'll have more than 3 million. Okay. So when analyzing these projects, these investment ideas, another thing that we want to consider, another thing that we want to take into account is the time value of money. So in finance, a lot of people just abbreviate TVM, meaning that it's time value of money. Meaning that $3 million now is not the same as $3 million 2 years later. Okay. Thirdly, we do want to take into account the risks of investing. For example, let's say if you build 2 factories in Japan, let's say the cost of 2 factories is going to be $100 million. And let's say the factories are operational for 30 years. So let's say over the 30-year period, the factories in Japan are going to generate some profitability for your business, whatever, let's say 8% profitability. 8% profitability. Relatively low, maybe because the wages in Japan are very high, so you'll have to pay a lot of salaries. A lot of the costs are going to be due to high wages in Japan. Well, perhaps you can build those 2 factories in, I don't know, Venezuela. For the same $100 million, say you can build those 2 factories, operational for the next 30 years. Wages are extremely low in Venezuela. The country has recently been destroyed by rampant inflation, hyperinflation even. So with low costs, let's say those factories, if you build them in Venezuela instead, are going to generate profitability not 8% as in Japan, but maybe 20%. 20% every year profitability. Are you going to build those factories in Japan or in Venezuela? You want to take into account risks as well. It's not only about the monetary value of the profitability, it's profitability versus risk. We want to take into account risk as well. So the risks in Venezuela would be quite high. Perhaps the government there might decide to take over some of your business. That will be very, very dangerous. So we want to take into account risk as well. We'll have a look at how it's done with different methods of analyzing those investments. And we want to have the ability to rank those investment projects. Ranking means saying which is better and which is not as good. Even if both are acceptable, remember, by the end of this analysis, one thing we want to arrive at is whether an investment is acceptable or not, accept or reject. Even if different options are acceptable, you can either build those factories in Japan or you can build those factories in Vietnam. If both are relatively acceptable, we want to be able to rank those projects. Okay, both are acceptable, but which is better? Okay, perhaps it's better to build them in Vietnam for this and these reasons, whatever it is. Okay. And lastly, we want to see how much will actually be generated from those projects, right? Okay, over the next 30-year horizon, what is the value that we are getting out of this project? We invest $100 million right now into those 2 factories. Over the next 30 years, what are they going to generate? $2 billion, whatever it is. Okay. Plus, we'll have to discount those, of course, because, as we've mentioned, money in future is not the same as money today. We'll have to discount those into today's dollars, see what's the value this project is going to generate in today's dollars. So we can compare apples to apples. Because if I go on with this investment, I'll have to spend $100 million to build those two factories, if it generates $2 billion over the next 30 years, comparing 100 million with 2 billion is like comparing oranges with apples. Dollars today is not the same as dollars in the future. So we discount everything to compare apples with apples in the form of dollars today. And in discounting, then we actually can also take into account the level of risk. Because with a more risky project, we can simply apply a higher risk, a higher interest rate, a higher discount factor. If the investment is more risky, then I discount it by a larger factor, bringing it into a smaller dollar value today. Okay. So we'll have a look at all of the details with several different methods, and we're starting with the most important one, which is the net present value. Net present value. Okay. So what do we do for the net present value? Well, we just have to get our head around for some future expected cash flow that the project is going to generate. Nobody knows the future, but we'll have to estimate that. So if I want to build the factories in Japan, I expect the factory is going to operate for 30 years. Perhaps it's not going to be 30 years. Who knows? Nobody knows the future. But let me make some expectations of how much cash they are going to generate over the next 30 years. That's going to be one thing that I'm going to need. Another thing that I'm going to need is I'm going to need a discount factor. Basically some kind of a return, required return, that I'm going to discount all of those future cash flows by. This discount factor will depend on the level of risk. It's going to depend on the level of risk. If the project is more risky, I apply a bigger requirement, and vice versa. Less risk, smaller requirement. And thirdly, then I can actually do the calculations for the net present value, have a look at the answer, what is the actual mathematical value, and then based on that number, as I mentioned, always our answer, final answer is going to be, do I accept or reject, build or not build? Okay. So what is that formula? Well, here it is, kind of long and tricky, a little ugly, a bit scary maybe. But we're gonna use Excel for this, and as you will see in a minute, everything is going to be very easy, very smooth with the help of Excel. Okay. Let's have a look at some examples before we move on to what we do with the calculation results. Let me copy this for our Excel calculations. Okay, so let's have a look at an example of calculating NPV for this particular business idea. So let's say we have a new project. You are looking at a new project and have estimated the following cash flows. Nobody knows the future, it's just an estimate. And we also have net income and book value and other things. For NPV, we only need the cash flows. But today we're going to look at other methods of evaluating investment projects as well. We're going to need those net income and book values for some other methods. So for now, we only need the cash flows. So one thing you want to do when you calculate NPV is you want to build a couple of columns like this. We have time, years, and we have cash flows. Okay, and time starts from 0 because before we get any cash out of the project, right now at time 0 we need to invest into the project first. I need to build those factories first, so I'm going to have a negative cash flow first. And then I have my investment horizon going into 3 years for this example. So perhaps this business idea is only going to last for 3 years. And then I'm going to enter the cash flows in the second column, in this case negative 165,000 at the beginning. That's the cost of building this project. In the first year, it's going to generate $63,120 in cash flows. In the second year, it's going to generate $70,800 in cash flows during the second year, and $91,080 in the cash flows during the third year. That's all, nothing else in this particular example. What else do we need before we start calculating NPV? Is a discount rate, or the required rate of return. Remember from several weeks ago, these are all basically different names for the cost of capital, different names for the interest rate, the minimum interest rate that you would require for this level of risk. In this particular example, the discount rate is 12%. That's all I need. Okay. Next, what we're going to do is hit equals. Very, very, very easy. NPV, open the brackets, and you get the hint over here. If you see, it's pretty small. It says rate. So first I'm going to enter the rates, then comma, and then all the values. But look, it says value 1, value 2, value 3, value 1, not value 0. Not value 0. This mistake is very easy to make. So we enter all of the values starting from value 1 up until the last value. We don't enter the original value first. Okay. Close the brackets. So this thing in Excel is kind of strange. Even though this formula for NPV is called NPV, once you do what it says, close the brackets, you haven't actually finished calculating NPV. So the way that Excel has been programmed in this case is not particularly great. Okay. As you see, I have it mentioned in the notes as well. I'm going to put these notes on Moodle. Remind me later. These are not on Moodle yet. So even in over here, we have a reminder in red. Remember to do this manually after you finish with the formula in Excel. Remember to do this manually after you finish the formula in Excel. And even again here, another reminder. In Excel, you gotta do this part manually. Very easy thing to forget. Even I sometimes forget it, but close the brackets, don't hit enter. This is going to be a wrong answer. Close the brackets, then plus this negative number that is the initial cash outflow. Then hit enter. Okay, then hit enter. That's what is the correct answer. That's going to be our net present value. So as the name suggests, this is net after costs. I've already subtracted the costs. Net being after costs over here. Present value, that means after discounting. I've already discounted these future cash flows by this discount rate to bring these dollars into today's value so I can compare everything in today's costs. Okay. We can actually do everything by hand to show that this really is net present value. Okay. Remember to discount future dollars into today's dollars. Let's say we have a timeline like this. To discount future dollars into today's dollars, I need to divide those future dollars, if you remember, by the 1 plus the interest rate into the power of number of years. That will bring those future dollars. In future, we're going to receive a cash flow of $63,120. It's going to bring it into today's value. Okay, so let's have this 1 plus the rate into the power of number of years into this in this column. So that's going to be equal 1.12 into the power of this. 1.12 into the power of 1 is 1.12, and the other ones are slightly different. So let's say present value of those future dollars is going to be equal to this $63,120 divided by 1 plus r into the power of number of years. That's divided by this column. And if you sum up everything, that's the total future cash flows discounted already to today's value. That's present value, that's PV. We've talked about PV over the last several weeks. And to go from PV to NPV, net present value, we need to subtract the original costs. So equals this PV plus negative costs is going to subtract those costs. Oh, look at this, it's the same number. Right? So that's what the computer is actually doing. If you forget how to use those Excel formulas, you can also just simply do that by hand. Just calculate the present value and subtract the original costs. Okay, that's our NPV. That's our net present value. And okay, so we've done the calculations. How are we going to decide whether it's a good investment idea or not? Well, our decision rule is such that if NPV is bigger than 0, only then accept the project. Only then accept the project. NPV shows us the value that the company is going to get out of this project in today's dollars, already taking into account the time value of money, already taking into account the risk level, because risk level is shown by this discount rate. Yes, if the project is riskier, this discount rate will be higher, right? So this is the value that the company is going to generate. So if this value is negative, it means that this investment is going to lose money for us. We don't want to take it. If this value is 0, it means we're not going to make any money investing into this project. Then why would we invest? So only if this number is greater than 0, that's when we accept the project. Okay. So let's say there are a couple of questions that come together with this problem. Question 1, how much is NPV? And question 2, accept or reject the project. Right. First question already answered. NPV is $12,627.41. And do we accept or reject the project? Yes, accept. Accept because NPV is greater than 0. Okay. So there it is. And again, when you have a look at this again on Moodle, you can review all of these calculations. These are how these are the explanation of how we can do the calculations by hand as well. This is how we do them in Excel. We need to remember subtract the initial investment by hand. Okay. So how do you guys think? Does this method, NPV is one method of analyzing the investment project, does this method consider the time value of money? Does NPV method of evaluating investment project take into account the time value of money? So are we comparing apples with apples when we look at the dollars, or are we comparing apples with oranges when we look at the dollars when calculating NPV? But since we have already done the discounting, the name itself suggests that it's net present value. We're already looking at today's value of all of the dollars. Even by hand over here, you saw that we have done the discounting by dividing all of the future dollars by 1 plus r into the power of number of years. We do compare apples with apples over here, so yes, this method does take into account the time value of money.